Well, according to Deloitte Canada's quarterly report on energy, oil, and gas prices, Canadian crude oil prices could go up this year as the Trans Mountain Pipeline expansion gets ready to actually ship oil. For more, we're joined by Andrew Botterill, National Oil and Gas and Chemicals Leader at Deloitte Canada. Andrew, thanks a great deal for joining us. I've got the differential between WTI, West Texas Intermediate, and Western Canadian Select at about $14.90 right now. Do you see the differential meaningfully narrowing in weeks and months ahead?
You know, when Trans Mountain does come on, there is absolutely the expectation that we'll see some of that narrowing. Just the fact alone that we're going to be able to have a real material second sales point for Canadian volumes, I think is just going to increase competition. And to be honest, we're going into summer driving season and with a lot of firm demand out there in the globe. So good news story for WCS and what it could fetch some of our Canadian producers.
Why would it not be priced in now where there seems to be certainty that this pipeline finally, after many years of delays, is going to ship in very early May?
I think that's a great question. I think it probably is sneaking in there a little bit, and I think people are starting to get a lot of confidence. It was a bumpy road to get to this pipeline coming in, of course. So I think some people will still be a little cautious, but at the end of the day, I do think people are starting to price that in and recognize what that's going to mean for Canadian producers, and especially those that have capacity and takeaway capacity on that pipeline.
So based on that, what is your outlook for oil prices heading into the summer season? And do you feel that the trends in the near term will be driven more by domestic issues or global issues?
You know, it's probably a little bit of both, in all honesty. When we were looking out over the rest of this year, we were expecting strong oil prices. To be honest, we've seen a big rally in the last 10 days or so that really is showing that summer driving season that you're talking about is coming in. People are starting to gear up for that, and demand is starting to pick up. So, you know, we were expecting and are expecting firm prices, especially through the summer, north of $80. We're trading well above that in the last week. But that is something that I think we're going to continue to watch. And will we see that softening as we go into winter? And how will producers deploy capital this summer and bring on new volumes, especially in the U.S., is going to be a big thing to watch.
We're still a ways away from quarterly results from the heavyweights of the Canadian oil and gas sector. I'm seeing Canadian Natural Resources will report on the third day of May. That sounds like it's going to be the third day of shipping on the expanded pipeline. But what have companies said thus far, Andrew, as everybody gets ready for this?
Well, it's been a long time coming, as we talked about, and I think producers, especially those that I mentioned, have the takeaway capacity on that pipeline, the ability to start to trade, broaden their portfolio in where they're selling and what their sales points look like in the North American and global context, actually participate in some of those global benchmarks that we see getting volumes into Asia, I think is a huge step for those Canadian producers, and I think they're going to be really excited in the ways that they're going to be able to trade and broaden their portfolio and manage through the volatility that invariably comes to our sector every once in a while.
You had a note of caution in your recent work on this, where you say there will be some volatility as the system adapts to new capacity. The system being the largely dominated by the pipeline question. And you say one issue that could have a significant impact on the sector this season is water supply. Explain that.
Well, absolutely. And I think water supply, the fact that we're sitting in March and April of this year in Western Canada and talking about potential water restriction this summer tells you what the snowpack looks like, tells you that we're in a really unique situation. And I think what's really unique about that situation is where we're expected to see water restrictions isn't Southern Alberta, where we have dealt with that a lot in the past. It's in northwestern Alberta and to northeast BC. Now, the volatility, I think, is going to hit everybody and everybody's operations, because they'll recognize that they're going to need to be creative in how they get water for fracking and processing, which means they're going to need to recycle more. I don't think this is going to affect people's budgets. I think they're still going to have the ability to deploy capital, but it means that operations are going to be a little harder this year with water restrictions on the horizon.
And how are you feeling right now about the outlook for natural gas? Obviously, it's been a tough home heating season for natural gas producers. But on the other hand, there's that underlying trend towards exports of liquefied natural gas. Could you tell us a little bit about what you're thinking on the gas market?
Well, absolutely, and to say it's been a tough year, I think is a little bit of an understatement, and especially how moderate this winter was, and what it meant for storage volumes. So certainly we've had a tough go on the natural gas, but I think a lot of Canadian companies look at just the materiality of LNG Canada and that project, saying that they're coming on stream here at the end of this year into 2025. Gives, again, much like on the oil side, gives Canadians access to another market, globally participating, but it's going to move a lot of volumes in new directions. So again, they're going to have probably some similar volatility as those, both the projects, the pipeline and the LNG Canada, get up to speed and move. But I think in the long term, it's going to be really valuable for Canadian producers to, again, be sending volume into the global market.
And back to oil, what is your take on big international factors like the Chinese economy and the curtailment of production quotas by OPEC?
You know, we've certainly watched the recent cuts from OPEC. It certainly is a major factor in where prices are today and the strength of those prices. And I think what we're hearing from global counterparts is that they're the pace at which those organizations and those countries are looking at maintaining prices above $80 seems to be something that's going to stay true through the year and is going to prop up prices. So again, you know, it's always the big question out there, and no one really knows where it's going to land. But those continued cuts, and actually the diligence of those countries to keep with those cuts and manage to them, have actually really helped to prop up the global supply market. But demand continues to grow, and you mentioned China, and I think we've got some good news stories about a lot of economies around the globe getting through a lot of their inflation, and we're seeing economies moving and therefore demand being relatively strong.